For my 2023 taxes, I will get a $91,000 tax deduction. And I'm actually doing this. I'm not just telling you to go buy a G-Wagon so you can use Section 179 to depreciate and deduct your entire business expenses that a lot of people spout on the internet. This is real, actual information that I use myself. What's up, guys? My name's Avery. I am a real estate agent and real estate investor in the Raleigh, Durham, North Carolina area. And real estate has some insane financial benefits, including tax benefits, which is what I'm going to talk about in today's video. It can be difficult to reap the full benefits of the real estate world from a tax perspective if you aren't working full-time in real estate and allow yourself that real estate professional status. But this loophole allows you to still work a full-time W-2 job and then take some of that active income that you're making and paying all of those taxes on, and then use your real estate and get rid of that major tax burden on the active side. And now with all of that active income I made and taxes I paid on my W-2 job, I can take that massive deduction that I get from this cool loophole and pretty much get all of that money back. Now, two major disclaimers. One, I am not a CPA. I hired professionals in order to complete this job, complete this study, and get this loophole into the works, because those are the people who know about this stuff, not some random guy on the internet, but at least you know other professionals helped me get to this point. And second disclaimer, if you're still watching this video, please make that thumbs up button blue, because I'd be really happy. As I mentioned, in the real estate world, there are a lot of awesome financial benefits: cash flow, appreciation, principal pay down, a ton of other things. But one of the biggest things are these tax benefits. And typically in the real estate world, you have what is known as passive income. Now, it's not 100% passive like people tout on the internet. You're still doing a good amount of work, but in comparison of the IRS, when they're looking at, let's say, when you're working a corporate job versus this real estate income, they call it passive. So if you make this passive income, you're still taxed on it a little differently than your active income. But the cool thing about real estate is you can take your passive losses and offset your passive income. So if you're making $100,000 from cash flow and your other rental properties, but then you build a brand new commercial building and it costs you a ton of money, you can offset those losses from year one in that commercial building from all of the money that you made in rental income over here. And that's really the beauty of real estate, because you can just continue buying properties every year, offset that passive income with those passive losses. And the even better thing about it is that passive income still comes in and you feel it, and it's pretty much on paper where those losses exist, and it doesn't really feel like it in your bank account. Now, the difference with this loophole is you're able to take that active W-2 income and offset it from the money that you're making from a short-term rental or an Airbnb. So in this video, I'm just going to go over one, what this actual strategy is and how you can utilize it yourself, and then two, my example of the numbers and things that I did in order to be able to take this massive deduction. This strategy is known as a cost segregation study. Now, a lot of people who aren't in my situation where you have a W-2 job and are also Airbnb operators utilize cost segregation studies all the time. A ton of real estate operators will do this who are full-time in the game. And this really just means that you are going to speed up the depreciation on your property. If you're newer to real estate, every single year you're able to take some type of deduction through a depreciation expense, because the way the IRS views your property is it deteriorates or depreciates every single year. And typically an accountant will take the useful life of the property, divide it by 27.5 years, and then you can take that deduction every single year on your taxes for whatever specific properties that you own. The difference with a cost segregation study is, instead of lumping the building and all of its components into one number and then dividing it by 27.5, is they will separate out pretty much all of the components of the building. So your windows, roof, appliances, they all have different useful lives that are shorter than 27.5 years, which will allow you to speed up that depreciation and take a much larger deduction in the first year. And so that's exactly what I did with the cabin that I own about a half hour from here that I use as an Airbnb property. So they looked at all the logs that built the structure of the cabin, they looked at the furniture, the hot tub that I added, they looked at all of the appliances, and then they took those and made a depreciation schedule and then got to that $91,000 number to allow me to take that massive deduction in year one. And now that $91,000 does not mean they took the total over the 27.5 years that you would normally have and put it all into year one. It just means they took a hefty portion and put it into year one. So every year after the 2023 taxes that I pay, I will still get a depreciation deduction, but it will just be smaller than if I did the entire 27.5 years. And actually, something else that's important to note is, because this is an Airbnb, it's considered like a hotel or hospitality, that the depreciation schedule is over 39 years. Again, I'm not a CPA, that's why I hire people. Now there's an important caveat with this loophole, which is why people probably call it a loophole. It's not really a loophole, it's just a tax strategy, is that you have to make sure that you don't just have a W-2 job and own an Airbnb, but you have to materially participate in that Airbnb. I don't know why that's so hard to say. Materially participate. So material participation pretty much just means you are the sole person who is operating this property. I believe you have to have at least 500 hours in order of you managing it. Now you don't have to be the cleaner. The cleaner can still come out there, but you have to do 100 more hours of work than the cleaner. This doesn't just mean messaging guests. It can be making sure that you take care of maintenance, that you were looking at pricing. When you were setting up the property, it took you a while. You might have stayed there for a few weekends. All of that time adds up for you to be the sole person to be taking care of this property. If someone else is property managing this property for you, it's gonna be a lot harder for you to justify taking this type of tax segregation study deduction. It pretty much means that you have to be the one doing a majority of the work, because if you are materially participating, they now call this active income instead of passive income. Now there are a few more things in order to qualify. That's why I consult a CPA. Like for example, you have to make sure the average stay at your property is less than 7 days. So this is considered hospitality, hotel, active income. That's really what they're just trying to figure out, to make sure that this is actually active rental income and not passive rental income like you would with a long-term rental. Obviously, as I've said a million times, make sure you confirm with a CPA, because this study personally cost me about $2,500. Now my return on this study will be significantly more than $2,500, but you obviously don't want to waste all of that money and then not get this massive deduction and just take the regular depreciation that you were going to anyway. So consult with a CPA and a cost segregation company before you go ahead and just think that this is the right thing to do because you heard about it from me. Now to my example. I bought a $290,000 cabin at the beginning of this year that I utilized for Airbnb. It definitely hits all of those standards that I materially participate, do a lot of work on this thing. I also spent a lot of time getting it ready and setting it up. And then I spent about also $40,000 on some construction and also mainly furniture. I thought of doing a cost segregation study because I heard about it, and I called a number of cost segregation companies, talked to my CPA about it. She also said it was a fantastic idea. After talking to a number of companies, I got a handful of quotes, and I reached the point of doing it with this company because it just made the most sense. And the total cost was $2,677. And now, like the title of the video says, they went through the whole thing, did the cost segregation study. They actually physically came to the property. I know a lot of cost segregation companies will just rely on photos, but I think that's what sold me on this one. One, it was the cheapest price, and two, they said they would physically come to the property so they could get the most out of this cost segregation study, and that led to this $91,744 deduction. Now, a deduction does not mean that is all $91,000 that I'm going to get back. That just means that my taxable income can be lowered by $91,744. And if I'm not able to take that full $91,000 in the year of 2023, I can move it forward into subsequent years. Most likely I won't be able to use it all. Again, not a CPA. She will have to confirm all of that. They just finished tax season, so she's not really trying to answer too many of my questions right now because I'm going to connect with her again in a couple of months when tax season rolls around again. But hopefully I will be able to use a good hefty majority of that and then move it on into subsequent years and continue taking some of these awesome deductions. And for my job, I pay about $35,000 to $40,000 in taxes, or I will in 2023. So I'll pretty much be able to get all of that back. Also, like I said, this is not the entirety of the depreciation that this building has to offer me for over the entire time that I own it. This is just a hefty portion that's getting pushed into the first year. I believe it's about 35%, and then the rest of that 65% will get doled out over those 39 years. Lastly, and the most important thing, is if you are planning to sell a property in the near term, do not do one of these studies, because if you are selling your property, there is something called depreciation recapture. So if I take this $91,000 deduction and I sold my property next year, I would basically have to give all the money back that I got in a refund, because you have to recapture the depreciation when you sell that property. The only important thing to note is that if you sell the property and do a 1031 exchange, you can defer all of those taxes and capital gains and depreciation recapture into the next building, and theoretically you could defer it forever and ever. So if you keep playing that game, then you should probably be okay. But again, consult a CPA before you make any of those decisions or spend money on a tax strategy like this. If you're looking to make some money and save a lot of taxes and you still have a W-2 job and you can't fully quit that yet, make sure that you try this strategy out. I think it's an awesome one if you can get into Airbnb. Again, be smart about how you're getting into Airbnb. Just because you buy one doesn't mean it will be successful, and then you can get a lot of your taxes back that you paid in your W-2 job, and then invest in more real estate and hit your boy up if you're in the Triangle, North Carolina area, so he can help you find more investment properties or just buy a house. Hopefully you guys liked that video, and if you did, make sure you subscribe so you can learn all about the real estate world. And if you haven't done so, scroll down and hit that like button. I would really appreciate it. And if you want to learn more about real estate or the agent business, also tap that notification bell so you get notified when I make videos like this. So thanks again for watching, and more wealth is coming your way.